What's going on, everybody? Happy Monday. So today I want to talk about my big tech China trade that I've been working on over the course of the past couple months. To start, I'm just going to kind of explain how I came to this conclusion, and then throughout the next couple weeks I'm going to kind of explain the different ways you can play it depending on your risk tolerance. So for starters, population. China has a 1.3 billion population compared to the United States 330 million. Second, education. In 1949, 80% of China was illiterate. Now that's almost completely gone, with only 3% of China being illiterate today. And finally, you have a lot of middle class growth. In the past decade, agriculture participation went from 60% to just 35% today. So in just 10 years, China decreased their agriculture participation rate by 25%, which frees up more people to become consumers. So you have this rapid transformation of the Chinese economy, and then you start to look at the investment. So the Shanghai Stock Exchange was opened in 1990. And just for comparison, the New York Stock Exchange was opened in 1817. So that's an extra 200 years, give or take, of the New York Stock Exchange being open versus the Shanghai Stock Exchange being open. But even in this short period, we've seen large rises and capital inflows here. So you have this, and then you also have financing. China already has $5 trillion in debt. Compared to this, the United States has $22 trillion. And before I say anything else, debt is not a bad thing. If you use debt to produce productive assets, that's perfectly fine. And that's what China has done. They've produced productive assets with this debt. So you have the stock market and you have the financing that's allowed all of this growth to happen. And then we come to the trade. I look at the two ETFs for emerging markets. China makes up 35% of these ETFs. The ETFs are VWO and EEM. So if you're trying to play it safe, you can just buy these ETFs and you get exposure to emerging markets, which is China and then Taiwan, India, and Brazil. So you're getting access to all this growth in the East. And if you look at where we are with technology as far as cell phones, the internet, and then 5G, which China will definitely have before we do, this growth is going to come a lot quicker than a lot of people are expecting. So if you're trying to play it safe, you can buy the ETFs. But if you dive into the ETFs, what you'll find is the top two holdings in those ETFs are Tencent and Alibaba. So again, if inflows start to go to these ETFs, Tencent and Alibaba benefit. But right now, there's a lot of bearishness with ETFs and then just with emerging markets in general because of this debt. And then also because of the protests in Hong Kong, because of the trade wars with Donald Trump and the United States economy. And then just because China is in a recession right now, they're struggling and the tariffs definitely aren't helping. So a lot of people are very fearful to invest right now. So even though Tencent and Alibaba are performing extremely well and they're great companies, they're not getting the same capital inflows that, say, a Google or a Facebook or Amazon has been getting for the past 4 or 5 years. But when you look at the growth prospects of these companies, I definitely think that they can get to those levels fairly soon. And then just to kind of summarize all of this, right now only 3% of wealth for Chinese people is in the stock market. So let's say if there's a real estate crash, people are going to experience the lack of liquidity in real estate, and I think a lot of people might actually turn to stocks. And so in the United States, we can't really do that because a lot of the stock market money is already from pension funds and people's retirement. So they can't really take that out, and if they do, that's going to cause the market to sell off just off people retiring alone. But in China, you don't really have this issue. So let's say that this increases from 3% to 6%. That's only a 3% increase in the amount of wealth in the stock market. That's going to double that amount just by that 3% increase. So when you look at just what a little more participation in the Chinese stock market from Chinese people would do to these companies, especially with safe havens like Tencent and Alibaba, there's a lot of room for growth there. So again, this is the safest way to play it. You have the ETFs, but then you also have Tencent and Alibaba, which are, really strong, safe companies, kind of like investing in a Google or an Amazon, where you're not really putting too much risk out there. And then I can go into more detail about some smaller companies that have just gone to market, both in Shanghai but also in the United States, because again, Chinese people aren't as accustomed to investing in the stock market as we are, so they actually come to the NASDAQ and the New York Stock Exchange to go public and get funding. But a lot of those companies are set up for a lot of growth in China once they get that funding. So again, I can go into detail about more of those smaller companies. Again, there's more risk obviously that comes involved with those companies. But if you want to have a small portion of your portfolio for more high growth, I would definitely encourage that. So as always, I appreciate you watching the video. I am not your financial advisor, so do not buy or sell any stocks based solely off what you hear on this page. This is for education and entertainment purposes only, and as always, Godspeed.